Thank you very much for being with us again today, Dominique. It's obviously been a very, very exciting week in the US with the Fed, with everything else going on. We had a bit of excitement over in Europe, but we'll be focused on your side for now. And you've got a holiday shortened week ahead, um, but still some interesting things to pay attention to. So how about, would you like to kick off by just sort of talking us through your view around just how hawkish was this pause, or was it not hawkish at all?
Ah, I think the market reaction is yet another example of people counting the trees, to the last leaf, green leaf, and missing the forest. So there was this enormous focus on the 50 basis point increase in the S&P Fed funds for 2023. And to be fair, I was expecting no increase at all. So I was completely wrong-footed. But this is not what's important. What is important is actually the S&P macro forecast. If you look at the change in the forecast for the past year and a half in the 2023 forecast, what you see is that the Fed has kept its unemployment forecast at close to cycle lows between uh, 4, 4.5, I mean, which are higher than now, but still historically very low. By contrast, the Fed forecast or core PC has kept increasing. The last increase was 30 basis points to 3.9% by the end of 2023, which is twice the Fed target. So, a few basis points here, a few basis points there,
Mhm.
and we start talking about serious inflation here. But what is this telling us? When we have the Fed expectation of inflation asymptotically converging to actual inflation, while unemployment remains at cycle low, what it tells us is that the Fed is actually focused mainly on the employment leg of its mandate and ignoring the inflation leg. That's what the data tells us. And forget all the talk, colloquiums, papers, TV interviews. Look at the data. That's what the data is telling you.
Yeah.
So next week, we have a number of speakers, hawks like Bullard, Waller, Bauman, Mester, doves like Goolsby, um, Barkin, Williams, but they are going to say the same thing, which is we expect more hikes. But perhaps with the exception of Goolsby, because if you look at the dot plot, there were 2 meeting participants who saw no hike increase this year, and I have a nagging suspicion this could be Goolsby and Cook. So, Goolsby could be the exception. But, no one is really addressing the issue, which is, yes, the Fed has hiked 500 basis point, but inflation has stabilized at about twice, more than twice actually.
Mm.
Core PC is about 4.5%, more than twice the Fed targets, and the kind of homeopathic hikes that the Fed is planning are not going to change that.
Yeah.
So, what is the Fed planning for the remainder of the year? During the meeting, Chair Powell kept repeating that since the Fed had already hiked 500 basis points, it was obvious, I'm using his own words, that they should slow. And so I think the plan of the Fed is simply to go for hikes every other meeting instead of previously every meeting. Are 25 basis point going to make 50 basis point going to make a difference? Of course not. So I actually think that, in terms of market impact, the market is wrong on the cuts priced in for this year.
Yeah.
Uh, Still wrong. Definitely this is not in the card. But at the same time, I don't see 2 extra hikes over the remaining 6 months of the year uh, as changing much the growth or inflation outlook So as long as the market believes the Fed claims that it really wants to bring down inflation back to target, and it seems to be the case, because if you look at the BE reaction to the Fed meeting, there was practically none.
Mm.
So I think the horizon for risk asset is open and bright. So I expect the rally to continue. So that's
Yeah.
my
No, that makes sense. I mean, and just to sort of boil down into those forecasts right now, because they have CPE ending the horizon pretty elevated still. Um, is that I suppose two questions. One, as a non-Fed watcher myself, is it a general thing where they generally have it sort of mean reverting back to target, like a lot of other central banks do, where you sort of it's a very strange thing to have it left missing for so long? And two, is this a sort of capitulation of like the target? They are now basically, as you sort of warned previously, looking like they're targeting somewhere above 2%, and they're going to be happy with that.
So a couple of points. I think you're absolutely right. There is something very ritualistic with these projections. When inflation was below target, the Fed would always show it at target at the end of the projection period. But I think it was less of an issue when inflation was below target.
Mm.
Now they have it above target, so 3.9% in 2023, 2.6% in 2024, and they have inflation so falling by 2.6%. So they have inflation falling by 130 basis points in 2024 relative to 2023, while cutting rates by 75 basis points. This is a joke. Come on. So I think the ritualistic approach to forecasting is okay when inflation is low, under target, or close to target. But when inflation is high, it signals that basically it's okay to have
Yeah.
inflation above target. Don't worry, be happy. Um, and inflation has been above target since the middle of last year, actually since 2021. And they have it converging to target over 3 years with a very weird policy projection. So basically they are losing more and more credibility
Mm.
as leave their targets well above, as I leave their forecast well above the targets. And so the question is, when do they start getting worried? I think either when we have a market reaction and we have Bs moving up, and the market starting to sell off because it realizes that
Yeah.
this story doesn't have a happy ending, or when we have a shock to inflation. Most likely shock would be energy price shock, but the consensus among energy traders is that there's more downside to prices or to demand at least than upside.
Yeah.
Um, so it's not so we could be in this sort of twilight zone with inflation falling 130 basis points while interest rates are cut.
Yeah.
Actually, they are cut 100 basis points next year. So who knows? I mean, it's possible. I don't think it will have a happy ending, but that could be quite a while away.
And is this a credibility issue? I mean, is this the kind of situation where you'd expect to see more inflation premium being priced into things like US rates, etc.? So more sort of selling in that space. If the market can't trust, I suppose, the Fed to fulfill that side of its mandate.
Yes, but the market seems to have drunk the Kool-Aid because the Bs are stable, and
Yeah.
the Fed is planning for inflation to be above target for 4 years.
Mm.
So eventually, the market, and also the market loves it, because loves the Fed story, because the Fed story is about costless disinflation. What's not to
Mm.
like? And so, yeah, either we need a shock or we need someone to say, oops, this is not going to happen. This is
Yeah.
going to be very painful. And I should start discounting that possibility. But we are not there yet.
So, and is the I mean we do have, as you mentioned, Powell testifying this week. At his Q&A, he got quite a bit of questioning around why pause now, which to be honest has been sort of a question across a lot of central banks as to, especially when they sort of bake things into their forecasts and then don't just do it now. And he didn't really have an answer to it. Do you think come next week it's just going to be more of the same kind of pressure, or is it going to be a different kind of focus, do you think?
So we're going to have the Democrats praising the Fed. I mean, what's not to like about this forecast? So a love fest between the Democrats and Powell. With the Republicans, as they are likely to be more critical. Does that make a difference in terms of Fed policy? Not really. I mean, for the Fed to get really worried, you would need Congress or consensus in Congress to put in place some legislation, that could increase accountability, and that's what the former that's what the Republican had in mind at some point before the end of the last Congress. There was a law that would have restructured the Fed, made the appointment of regional Fed presidents subject to congressional approval. That law never saw the light of day. There was too much on the legislative agenda. So the bottom line is that there are no checks and balances on the Fed, and I don't see, frankly, neither the senators or the House members taking the SCP and asking Chair Powell how he expects inflation to fall with a 100 basis point cut next year.
Yeah, no, I appreciate it can be infuriating watching politicians question central bankers, especially when they haven't read stuff. But otherwise, it's a relatively data light week next week for the US at least. Are there any sort of events of interest though that you might think of?
So yeah, data-wise, we will have some blissful boredom, I hope, because everybody who's been on this market will enjoy a bit of a lull in the data. I mean, we have the S&P PMIs, but you know what? They are going to show that manufacturing is still contracting, that services is still expanding. And in general, there is a problem with soft data, so survey data post-pandemic. It's become really detached from hard data. So these are fairly noisy data points. I won't be paying a lot of attention. And otherwise, we have a string of real estate data, building permits, housing start, existing home sales, and I think they are likely to show the market bottoming out still. So possibly a small positive surprise in housing start and existing home sales, because the consensus seems a little pessimistic, but nothing market moving. No, the more interesting story, it's not just for this week, but next week as well, is the Supreme Court ruling on the student debt forgiveness. Everybody expects it will get struck by the Supreme Court, because we're not talking about small change. You're talking about 400 billion or so in present value cost. So that's 1.5% of GDP. And I would argue that the administration doing this without congressional approval is really a violation of the power of the purse. So I'm not a constitutional expert, obviously, far from it, but I suspect this will get struck. Fear not. It does not mean the end of the expansion, because in January, the administration has announced a modification of payment plans for student borrowers, and some private sector outfits like NerdWallet, for instance, think that it will cut by more than half the debt service that students pay. So student loan payments are to start at the end of August, but I suspect it will be a slow start, perhaps gradually phased in. And also by that time, the administration will have put in place some new rules, um, possibly Supreme Court proof rules to decrease the pain. So that could be the surprise over this week or next, because after that the Supreme Court is on holiday break, on summer break, and they promise to rule on the forgiveness before their break. So that's the main thing I'm looking at.
No, cool. No, thanks very much for that. No, it's a
Why don't we, Henry, why don't we turn the table and let me ask you about your very interesting paper on central bank and profits. This is a new story, and I think super important to understand inflation and central bank policy.
no, sure thing. I mean, it's going to be an interesting week. As we say, we had last week with the ECB, this week the Bank of England, and some of the things that have kind of certainly, even outside of the economic sort of sphere of people that we sort of usually talk to day to day, there's a lot of, I suppose, lack of clarity around why do central banks care about wage growth, and why not other things. So kind of on the back of that, we kind of pulled together a sort of explainer on exactly how different central banks, so because it's me, Bank of England, ECB being the main focus, um, how do they view wage growth versus profit growth, and why? And what we found is quite interesting. There is a great disparity between the attitudes of the ECB and the Bank of England. ECB's has been much more sort of holistic, I suppose, in terms of criticizing not only, or at least calling attention to, not only wage growth, but also profit growth across sectors, and also government spending, so especially untargeted government spending. So to sort of paraphrase a very ill-taken quote from Bank of England chief economist Hugh Pill, someone has to bear the cost of inflation, and really it's going to be either corporates, individuals, or eventually the government, and obviously that's tax, so eventually someone else. But I mean, the Bank of England has been sort of adamant that profit hasn't risen, it hasn't sort of driven an increase in price based on sort of greedflation, what's been called, and that's been across the spectrum. So we've heard from Haskell, from Dingra, from Broadbent. They've all kind of done their own analyses and come to the exact same conclusion. And it's quite strange because when you look at the data, at the very least, you can argue that UK corporate profits have risen at least as much as European ones, and the Europeans yet are so much more focused on profit than the Brits, apparently, in terms of policy making. So it's kind of just a rundown of how the data looks, and also what it might look like for the future. Because I mean, at this stage, I mean, we know from last year, the UK in general has been very loath to target corporate profits through windfall taxes, etc. It took a very long time for them to agree, even on the energy front. By comparison, the Europeans were pretty fast on it, and for example, the Spanish went after banks as well. So looking ahead, I mean, if we've got a situation where I mean, the UK government's now looking at price caps, which we don't know if that will come via subsidy, or will it be just a sort of forcing through regulation, basically forcing companies, particularly retailers, to take a profit hit. It could be that corporate profits become more in focus in the future from policy perspective. And across Europe in particular, that's probably where I'd be sort of more closely watching it, just because we've got a little bit more populism there right now. We've got the Italians with the FDI. We've got the Spanish going into elections. There's a chance that they could end up with a bit more populism there. And it's a much more sort of spoken about topic, it seems. So it's just a sort of highlight of something to watch in the sort of probably more medium term. But
No, no, absolutely. I mean, populism is on the rise all over the world. And so, I mean, the issue of profits also came up in the US.
Mm.
and it's not going to go away. So that's and to be fair, in economics term, inflation, you clearly, we have high inflation at the moment. We have a feedback loop between wages and prices, so wages and profits. So it would make sense for central banks to be focused on profits as much as on wages. In fact, the smart thing would be for central banks to demand more robust competition policy to prevent markup behavior from feeding through into inflation. So it's definitely something to keep following. And I thought your note was really super interesting.
Oh, thank you very much. That's good that someone's reading it. But it's not the only interesting thing on our website, as ever. We've got quite a lot of stuff. So, as per usual, just to sort of highlight to our watchers. Obviously, we have Dominique's review of the Fed. Some really great insights on that. A lot of the stuff that we've discussed today. We've got all our usual pieces. You can come and see Bilal's recent Bloomberg interview. He's written a piece on which companies have outperformed in equities. We've got our oil weekly. We've got for the prime side, all of Richard's pieces on currency and looking at euro particularly. And so, yeah, please do check all that stuff out and get in touch with us and let us know if you've got any feedback. Take care, and as always, thank you very much for joining us.